The Nikkei just lost over 1,400 points in one session, and it's staring straight at the 66,270 trap. Here's the brutal truth. Monthly trend, still strong buy. Weekly trend, strong buy. But the daily and hourly are screaming strong sell. That clash is pure volatility fuel. I've got 2 scalp entries and 1 swing trade that capture either the bounce or the flush. Exactly 66,270 is the line. Lose that, and we are testing 65,348 fast. Hold it, and the mean reversion beast wakes up. Nikkei just went into freefall, down over 1,400 points, a 2.1% collapse in a single session. But while the retail crowd is panicking, you and I are going to see the one danger zone and the one hidden opportunity that nobody's talking about. Right now, price is sitting at 66,819, and it's hurtling toward the most critical pivot of the entire month. In the next 12 minutes, I'm giving you 2 scalp plays you can execute today, plus 1 swing trade that aligns with the bigger picture. Stay to the end. The final level I give you determines whether the monthly bull trend survives or completely resets. Let's anchor the instant market verdict. My session bias is fading intraday weakness into the key support cluster. This is not a blind dip buy. It's a structured play with a single invalidation level that flips the bias. Write this number down. If we get a 4-hour close below 66,270 today, the entire multi-week structure resets, and I switch from fade to full breakdown mode. That's the trap. The herd is positioned short on the hourly time frame, crowding into momentum. That extreme positioning is exactly what creates a bear trap when we approach a massive structural support. I'll show you why. Now let's walk the chart from top to bottom, and I want you to listen like a trader who's already in the position. On the monthly, the trend is a strong buy. Prices are comfortably above the 200-month moving average, and the rally from last year still holds the dominant structure. The weekly trend is also a strong buy. No ambiguity. When we zoom down to the daily, we see the first crack. The daily trend has flipped to sell. That's important because it tells us short-term momentum has deteriorated sharply. Now drop to the 4-hour and the 1-hour. Both are printing a strong sell. That's a classic picture of a corrective wave inside a secular bull trend. The money is made in the transition zone. Look at the moving averages. The MA5 at 68,298 and the MA10 at 69,020 have completely broken. Prices slice through them like a hot knife. The MA20 on the daily is at 68,933. That level, which was support last week, is now overhead resistance. And here's where it gets interesting. The 50-day moving average sits at 66,456. Just above our critical pivot at 66,270. So we have a confluence, the 50-day MA and the S1 support forming a thick, heavy floor. Below that, the 100-day MA is way down at 63,069, and the 200-day at 57,716, both sloping higher. The broad bull trend remains intact. But the market is now asking, will the 50-day hold? Now, let's talk momentum and the hidden divergence that most traders miss. RSI 14 is at 44.5, not yet oversold. That tells me there's still room to fall before we reach an exhaustion point. MACD is declining with the signal line rolling over. Bearish momentum is accelerating. But here's the twist. Stochastics is printing a bizarre 94.3, deeply overbought, even after a 2% crash. Williams %R is minus 8.8, pinned near overbought extremes. That tells you this sell-off erupted from severely overbought conditions, meaning the flush could be fast and violent, but it also means the rubber band is stretched. When an instrument falls this fast from overbought, it often snaps back just as aggressively once it hits a solid support. That's the opportunity. The danger is that the overbought readings get fully unwound with more downside. Add the ADX at 25. The trend strength is moderate, not yet a runaway freight train. That means the 66,270 level has a genuine chance to hold because trend strength alone isn't overwhelming. Average true range is a gigantic 1,931 points. This is a high volatility beast. You must respect your stops. Now let's weave in the fundamental driver. The only headline that matters is the yen. The Nikkei is the yen's heartbeat. Yesterday, the market smelled a hawkish shift from the Bank of Japan. Speculation is building that the BOJ will tweak yield curve, control, or even hike sooner than expected. The dollar-yen cracked, and when the yen surges, Japanese exporters get crushed, and the Nikkei freefalls with perfect inverse correlation. If you were watching the bond spreads and the yen futures, you saw this coming. So the question now is the yen strength priced in, or is there another leg coming? I'll give you my lean. I think this week the dollar-yen tests 144, and if that breaks, the Nikkei could spill right through 66,270 and target 65,348. But if the BOJ walks back the hawkish whispers, or if US yields bounce, the yen retreats and the Nikkei rips higher. That binary event makes the 66,270 line the battle zone, and so here's your 2-week directional lean. As long as the Nikkei holds a daily close above 66,270, the bull trend correction is buyable, and I target a rebound to the 69,000 resistance zone. A daily close below 66,270 with a lower dollar-yen close invalidates that entirely and flips my medium-term view bearish towards 63,500. Right now, the edge lies in the long side near support, with extremely tight invalidation. Second interaction trigger. Do you think the yen pushes dollar-yen below 144 this week? Comment yes or no right now. I'm tracking this community's consensus against institutional flow. Most people skip this next part. That's exactly where the money is made. Keep watching. I'm going to lay out 3 specific trade plans, and I want you to write these levels down. Strategy 1 is the opening scalp. This is a high probability bounce play off the 66,270 support zone, executed on the 5-minute chart during the Tokyo Session Open or the European overlap. The trigger is precise. Wait for price to approach the 66,300 area. We don't just blindly buy. We need a 5-minute bullish engulfing candle that forms after a tap and hold above 66,270. The moment that engulfing candle closes, you enter long at 66,340. Your stop loss goes right below the structural floor at 66,220, a mere 120 points of risk. Take profit 1 sits at 66,750, just under the first minor resistance. That's a solid 1 to 3.4 risk reward. If momentum really fires, take profit 2 at 67,200, near the MA5, can be targeted. This scalp is void instantly if the 5-minute candle closes back below 66,270 before triggering. Do not chase. And here's the on-screen graphic I want you to visualize. The opening scalp. Entry: 66,340 on 5M bullish engulfing after tap of 66,300. Stop loss: 66,220. Take profit 1: 66,750. Take profit 2: 67,200. Risk, reward: 1:3.4R to TP1. Invalidation: void if any 5M close below 66,270 before entry. Strategy 2 is the liquidity grab. This is a counter-noise scalp that exploits the stop hunt. In a freefall like this, algos love to run stops below obvious support. So here's the plan. If price slices through 66,270, pierces down to 66,100 or even 66,000, and then within 2 5-minute candles snaps back and reclaims 66,270 with a sharp bullish rejection wick, that's your signal. Enter long. On the reclaim of 66,290. Your stop goes just below the sweep's low, placed at 65,950, about 340 points of risk, but you're trading the fake out. The target is fast and singular, the nearest intraday liquidity pool at 66,700. That's a 1-to-1.2 risk-reward scalp. This demands rapid execution. If price doesn't reclaim within 3 candles, the play is dead. The session swing I'm about to give you is the real monster. But before that, another interaction cliff. Are you scalping or swinging this week? Comment the word scalp or swing right now. I want to see where this community sits. The liquidity grab. Entry: 66,290 on a sharp reclaim of 66,270 after a false breakdown to 66,000 area. Stop loss: 65,950. Take profit: 66,700. Risk, reward: 1:1.2 R. Invalidation: void if price fails to reclaim 66,270 within 3 5M candles. Now, strategy 3 is the session swing. This is the trade that aligns with the monthly strong buy and targets a multi-session mean reversion. I want to see a 4-hour confirmation. The trigger condition is a 4-hour close above the 60-period moving average, which is currently sloping down around 67,500, combined with a bullish MACD cross on the same 4-hour chart. That tells us the correction is exhausting and the trend is resuming. So here's the plan. Once we get a 4-hour close above 67,520, you enter long at 67,550. Your stop loss is placed below the daily structure, specifically below the 66,270 pivot and below the 50-day MA at 66,150. That's a 1,400-point stop, so size accordingly. Take profit 1 is a conservative swing target at 69,000, right at the R1 resistance and the broken MA20. That's a 1-to-1 risk-reward. Take profit 2 stretches to 70,879, the R2 level, for a 1-to-2.4 risk-reward. Once price reaches halfway to TP1, around 68,250, move your stop to break-even and trail it by half the ATR, roughly 965 points, to lock in the swing. The entire swing thesis is invalidated if we get a daily close below 66,150. That would confirm a trend failure and I would exit any swing long immediately. Here's the on-screen plan. The session swing. Entry: 67,550 on 4H close above 67,520 with bullish MACD cross. Stop loss: 66,150. Take profit 1, 69,000. Take profit 2, 70,879. Risk, reward: 1:2.4 R to TP2. Invalidation: void if daily close below 66,150. Never risk more than 1 to 2% per trade. On scalps, keep risk even tighter because volatility is extreme. Those 1,900-point ATR ranges will vaporize oversized positions. No positions through high-impact BOJ headlines or US yield surprises. Stops are non-negotiable. This is how you survive to trade the next big move. Let's close this with the only number you need to on your screen for tomorrow: 66,270. That is the line. If it holds and we see a bullish 4-hour structure, we are looking at a vicious snapback rally that could tag 69,000 within days. If it breaks with a daily close below, the entire monthly trend comes under threat, and my focus shifts immediately to the short side targeting 65,348, and then 63,504. Tomorrow, I'm watching the Tokyo Open liquidity gap and whether the yen stabilizes above 144. If dollar-yen pierces that level, the Nikkei freefall extends, and I will have the updated blueprint exactly 24 hours from now. So smash the like button and hold it. That subscriber bell lets the algorithm deliver these levels before the market moves. If you want the full breakdown on the S&P 500 gamma flip and the Bitcoin divergence from equities, that video is live now. Tap the end screen and let the binge loop carry you. I'll see you tomorrow, right here, with the critical verdict. Until then, scalp the noise, swing the trend.